All right, hello class. So today what we're going to do is we're going to be studying chapter 11, which is dealing with some different decisions that are made within the organization. So managers in large organizations, they have to delegate some decisions to those who are in lower level within the organization. And so this chapter explains how responsibility accounting systems, the return on investment or ROI, residual income, transfer pricing, and the allocation of service costs are used to help to control decentralized organizations. Okay, so chapter 11 is responsibility accounting systems. So first of all, what is a decentralized organization? A decentralized organization is one that does not confine decision-making authority to a few top executives. Rather, decision-making authority gets spread out throughout the organization. The advantages and disadvantages of decentralization are as follows. So the advantages of decentralization are that it enables top management to concentrate on strategy, higher level decision making, and coordinating activities. So it gives the higher level managers the ability in order to do that. It acknowledges that lower level managers have more detailed information about local conditions that enable them to make better operational decisions. So it allows lower level managers to be able to use the input and the knowledge that they have to be able to make decisions. It also enables lower level managers to be able to quickly respond to customers. So lower level managers are able to respond to the needs of customers. It also provides lower level managers with the decision-making experience they will need when promoted to higher level positions. So it allows lower level managers to be able to gain experience in making the types of decisions that they would need when they promote. It also increases motivation, resulting in increased job satisfaction, retention, as well as improved performance. And so that's something, again, in organizations we want to do. On here, it says it leads to job satisfaction. And that's something we want to do. Obviously, we want to give our other employees the increase their motivation, their job satisfaction, their engagement within the organization. We want to do that. And that allows them to be more loyal to the organization. So decentralization, these are the benefits. Now, some of the disadvantages of decentralization are that lower level managers, they might make decisions without fully understanding the big picture of the organization. So the upper level managers, they're, thinking more about the big picture, whereas the lower level managers, they may not be so keyed into that. So it's important. There may be a lack of coordination among autonomous managers because one manager might do one thing in one location, another one might do something in another location. So the balanced scorecard is something that can help to reduce this problem by communicating a company's strategy throughout the organization. And we will talk about that and more about what the balanced scorecard, what it's about. Lower level managers may have objectives that might differ from those of the entire organization. And so again, this problem can also be reduced by designing what they call performance evaluation systems that would motivate managers to make decisions that are within the best interest of the company. Sometimes managers, they might want to do what's going to make them look good or have different motives than what would be in the best interest of the organization. But by designing performance evaluation systems, then that way managers know then what they're going to be all evaluated against. It also is difficult to efficiently spread innovative ideas within a strongly decentralized organization. So if it's strongly decentralized, then it might be difficult to share those and to get those throughout the organization. Okay, responsibility accounting. Responsibility accounting systems, they link lower level managers' decision-making authority with the accountability for the outcomes of those decisions. And the term responsibility center is used for any part of an organization whose managers have control over and is accountable for cost, profit, or investment. The three primary types of responsibility centers are cost centers, profit centers, and investment centers, and we'll go into that some more. So a cost center. A cost center is one where the manager has control over costs, but not over revenue or investment funds or how investments are being made within the organization. Service departments such as accounting, general administration, legal, and personnel, they are often classified as cost centers within, as are manufacturing facilities. So things where it's providing service internally are generally, going to be considered cost centers. Standard cost variances and flexible budget variances, such as those that we've looked at in the previous chapter, chapter 10, and now in chapter 11, are often used to evaluate cost center performance. Now, a profit center. A profit center is where a manager of a profit center has control over both their costs and revenues. Profit center managers are often evaluated by comparing actual profit to targeted or budgeted profit. But again, they have control over both revenues and costs. And generally, a profit center, it might be like somebody that runs like a store, manager of like, let's say, a Starbucks, may operate in as a profit center, possibly. Depending upon how the organization, if it is truly decentralized or not. Now, an investment center is one where the manager of an investment center has control over costs, revenues, as well as the investments in operating assets. Investment center managers are usually evaluated using the return on investment or ROI or residual income, and we will get into in a few minutes. Okay, so the first thing that we're going to look at is looking at evaluating investment center performance and specifically dealing with return on investment, otherwise known as ROI. So again, investment center performance is often evaluated using a measure called return on investment or ROI. And it is defined as the net operating income over the average operating assets. So again, our net operating income would be our income not considering interest before interest and taxes. And then our average operating assets would be like our cash, our accounts receivable, plant, property and equipment, and other productive assets. And our net operating income is the income, as I said, okay, so we already went over that. Now, our net operating income is used in the denominator because the denominator only consists of operating assets. The operating asset base used in the formula is typically computed as an average of the assets between the beginning and the end of the year. And another area that goes into this is the net book value versus gross cost. Most companies use the net book value, which would be the acquisition cost less accumulated depreciation of depreciable assets to calculate the average operating assets. With this approach, ROI mechanically increases over time as the cumulative depreciation increases. Replacing a fully depreciated asset with a new asset would therefore decrease ROI. Now, an alternative to net book value is gross cost of the asset, which ignores the cumulative depreciation. And so with this approach, ROI does not grow automatically over time. Rather, it stays consistent. Replacing a fully depreciated asset does not adversely affect ROI. So two different ways to look at it. Okay, understanding ROI. So DuPont pioneered the use of ROI and recognized the importance of looking at the components of ROI, namely margin and turnover. Margin is computed as shown, so net income over net sales, and is computed and is as shown and is improved by increasing unit sales, increasing selling prices, or reducing operating expenses. The lower the operating expenses per dollar of sales, the higher the margin earned. And then turnover is computed as sales over average operating assets. It incorporates a crucial area of a manager's responsibility, the investment in operating assets. Excessive funds tied up in operating assets depress turnover and reduce ROI. So remember that both margin and turnover affect profitability. And so one way to look at that is to think about the margins and turnover of grocery stores to jewelry stores. In equilibrium, every industry should have roughly the same ROI. Groceries, because of their short shelf life, have a high turnover relative to fine jewelry, right? So you might have, obviously a grocery store, their uh, items are going to turn over much faster, right? Because, the grocery stores, we have spoilage, we have things. Whereas a jewelry store, they can have something on display or an inventory for a very long time. In fact, here, I'll take something off, I'll show you. So I went, I've had it for a while, but I bought a new kind of do this, a new wedding band. So the blue doesn't want to show up. And she pulled that out. I told her what size I needed and what I was looking for. And when I bought that at the place in the mall, she pulled it out of she had a bag that had a bunch of these different tungsten rings in it. She doesn't care how long it's going to be there because it's not going to spoil. It's not, eventually someone's going to buy it. They might eventually try to discount it if it's been there, too long, but to bring in new styles, but obviously it doesn't take up a lot of space. So it's not, not a big deal. But just realize that turnover, there are some businesses that, require obviously for them to turn over their inventory a lot faster. If the ROIs are to be compared to grocery stores or in jewelry stores, the margins would be higher in jewelry stores. Obviously, jewelry stores have a much higher margin on their product for what it costs them versus what they're going to sell it for, right? Kind of keeping with that. So to illustrate how to increase ROI, we're going to assume that the Regal company had net operating income of 30,000, that they had average operating assets of 200,000, sales of 500,000, and operating expenses of 470,000. And so we're going to take a look then at what their ROI is. And so given this information, their current ROI is 15%. So we take their net operating income divided over their sales. We're going to multiply that by their sales over their average operating income. So 6% times 2.5 is going to give us 15%. So the margin multiplied by the turnover. Now, let's assume that Regal's manager invests in a $30,000 piece of equipment that would increase their sales by $35,000. So now their sales are $535,000, and are operating, but it also increased their operating expenses by 15,000. So now they're 485,000. What would be the ROI in this case? And again, working this out, we see then that the ROI would increase from 15% to 21%. Now, some criticisms on ROI. Just telling managers to increase ROI may not be enough, as managers may not know how to increase ROI in a manner that would be consistent with the company strategy. Because again, we need to keep within what the company's strategy is going to be. So just saying that isn't going to be enough. This is why ROI is best used as part of a balanced scorecard. A manager who takes over a business segment typically inherits many committed costs over which the manager has no control. This may make it difficult to assess that manager relative to other managers. So again, you're putting a manager in a position. There's been things that have gone on there in the past. They've inherited it. They have to work with what's there and obviously build upon it. But it's going to be hard then to say what did that manager do versus what did the previous manager do. A manager who is evaluated based on ROI, they might reject investment opportunities that would be profitable for the whole company, but that would have a negative impact on that manager's performance evaluation. Because again, managers are going to be concerned about what their individual performance is going to be, because that's what they're evaluated, their bonus is going to be on. But really, they ought to be looking at what would be the best for the organization. But obviously, it's human nature. We're going to think about what's best for us. So when discussing the criticisms of ROI and other measurements of profitability, it's important to think about a manager who anticipates being in the role of just a short time, having a short tenure. This manager would want to increase ROI as quickly as possible. And so you can think about what would be some of the activities that could be undertaken to increase ROI that in reality would hurt the company as a whole. There might be things that while it would increase ROI, it would negatively impact the company. Okay, so now we're going to take a look at residual income and compute residual income and explain its strengths and weaknesses. So first of all, residual income is the net operating income that an investment center earns above the minimum required return on its assets. And so calculating residual income, we see the equation. So it would be the net operating income, and we're going to subtract from that the average operating assets multiplied by the minimum required rate of return. And this computation differs from ROI. Remember that ROI measures net operating income earned relative to the investment in average operating assets. Residual income measures net operating income earned less the minimum required return on average operating assets. So we'll take and look at an example here. So Zephyr Inc. as an example. Assume the information as given for a division of Zephyr Inc. So we see that the retail division of Zephyr Inc. has average operating assets of 100,000 and is required to earn a return of 20% on those assets. And so in the current period, the division earns $30,000. What would be the residual income? And so again, we're going to figure out then that the residual income is 10,000. That is computed by subtracting the minimum return, which is 20,000, by the actual income, which is 30,000. So it's what is in excess of what the required return is. Motivation and residual income. The residual income approach encourages managers to make investments that are profitable for the whole company, but that would be rejected by managers who are evaluated on ROI. More specifically, it motivates managers to pursue investments where the ROI associated with these investments exceeds the company's minimum required return, but is less than the ROI being earned by the manager. So residual income, it helps the manager to be able to make decisions that would be beneficial to the whole, not just to not just to them. So we have here a quick check. So Redmond Awnings, a division of Wrap Up Corp, has a net operating income of 60,000, and average operating assets of 300,000. The required rate of return for the company is 15%. What would be the division's ROI? And it would be 20% because you're going to take 60,000 divided by 20 by the 300,000. You're going to take the operating income divided by the average operating assets, and that's going to give you 20%. But what we want to know is what if the manager of the division is evaluated based on ROI, would they still make an investment of 100,000 that would generate an additional net operating income of 18,000? And the answer is no, because doing that, it would lower their ROI down to 19.5. So no, because they have to have at least 20% ROI, we said. And then if the company's required rate was 15%, would the manager make this investment? Then they would, because it's going to exceed the 15%. It's going to be 18%. And then what would be the required rate of return for the company at 15% for residual income? And so it would be 15,000. So 60,000, which is the operating income, minus the return, which is 15% of the 300,000, which is their average operating assets, which is 45,000. And we take 45,000 from 60, our residual income is going to be 15,000. And then if the manager of Redmond Awnings is going to be evaluated based on residual income, will she want to make the investment of 100,000 that would generate a net operating income of 18? And she would, because she's met that. She's making at least she's getting that so she's going to have residual income of 18,000, and that's what we need to have. So yes. Okay. So now learning objective 3 is to determine the range, if any, within which a negotiated price should fall. So again, working to set prices. So a transfer price is the price that's charged when one segment of the company provides goods or services to another segment of the company. While domestic transfer prices have no direct effect on the entire company's reported profit, they can have a dramatic impact on the profitability within a division. The fundamental objective in setting transfer prices is to motivate managers to act in the best interest of the overall company. Sub-optimization occurs when managers do not act in the best interest of the overall company or even their own division. And one thing to look at is, remember that the good transfer price is one that induces division managers to do whatever is in the best interest for the entire company. And sometimes we think that that divisions should make all purchases internally wherever possible, which of course is not the case. They also sometimes need to remember that the purpose of transfer pricing and their zeal to be fair to the various divisions. So it's not about being fair, it's about doing what's best for the organization. So there might be a time where maybe working within your organization is not in your best interest, to subcontract that out to someone else. So there might be times where that's the case. So there are 3 primary approaches to setting up transfer prices, namely negotiated transfer prices, transfers at the cost to the selling division, and then transfers at the market price. And we'll go into what each one of these is about. So negotiated transfer prices. A negotiated transfer price results from the discussions between the selling and the buying division. Negotiated transfer prices have two advantages. They preserve the autonomy of the divisions, which is consistent with the spirit of decentralization. And a manager's negotiated transfer price are likely to have much better information about the potential costs and benefits of the transfer than others in the organization. The range of acceptable transfer prices is the range of transfer prices within which the profits of both divisions participating in the transfer would increase. The lower limit is determined by the selling division. The upper limit is determined by the buying division. So we'll take a look at a grocery store example. Assume a grocery storehouse example. Assume the information as shown with respect to West Coast Plantations, WCP, and Grocery Mart, both companies that are owned by Grocery Storehouse. So again, looking at, buying the grocery store, buying the oranges, but they also grow their own oranges. And this happens a lot. There are a lot of companies, Mart, believe it or not, they own a company called Superstore Industries. So a lot of your Save Mart products are made by the Save Mart companies, believe it or not. And so obviously that division has to make money, as of course does the store as well, right? So thinking about that, some of that might have changed now that Save Mart now went private, and then they already were private, I guess, but they sold out to the company now, the Canadian company that owns them now. And some of the other things, some of that might change, but realizing that Save Mart makes some of their own products, and then also, and makes a lot of their own products, and then of course sells the products in the store. But both the divisions need to make a profit as well. So kind of take a look at this. So the selling division, WCP, their lowest acceptable price is going to be as shown. So West Coast Plantations, they can harvest 100,000 crates of oranges a month. And the variable cost that goes into each crate of oranges is $10 per crate. Their fixed cost per month looks like maybe $100,000. I think there's a mistake there. I'm not sure. So the selling price that they want us, if they were going to sell it to an outside organization, would be $25 a crate for the oranges. But then Grocery Mart, they want to buy the oranges to sell in their stores. So they are willing to purchase them for $20 a crate, and they would buy 1,000 crates of oranges. Okay. So so we see that. Now, if Grocery Mart has no outside supplier for comparable oranges, then its highest acceptable price would be equal to the amount it expects to earn by selling the oranges, net of their own expenses, if they couldn't get them from anywhere else. Okay. But now we'll calculate the lowest and highest acceptable transfer prices in this scenario. So if WCP had significant idle capacity, or 3,000 crates to satisfy the demand of 1,000 crates without sacrificing sales to their other customers, then the lowest and highest transfer prices would be computed as follows. The lowest acceptable transfer price would be 10, and the highest acceptable transfer price determined by the buyer would be 20. So 10 for the seller, 20 for the buyer. Therefore, the range of acceptable prices would be between $10 and $20. Now, if WCP had no idle capacity and must sacrifice other customer orders so they only they have to give up an order of 1,000 crates going to one customer in order to fulfill for their own internal customer, then the lowest and highest prices would be as follows. So the lowest acceptable transfer price by the seller would be 25, and the highest acceptable price for the buyer would be 20. Therefore, there is no range of acceptable transfer prices. This is a desirable outcome for groceries storehouse because it would be illogical to give up sales of 25 to save costs of 20. So then they would try to look maybe somewhere else outside of that. Now, if WCP had some excess capacity, 500 crates, and they would have to sacrifice other customer orders for another 500 crates to meet the demand of 1,000 crates, then the lowest and highest possible transfer prices would be the lowest acceptable transfer price as determined by the seller would be $17.50, and the highest acceptable transfer price as determined by the buyer would be 20. Therefore, the range of acceptable transfer prices would be $17.50 to $20. Now, if a transfer within the company would result in a higher overall profit for the company, there's always a range of transfer prices within which both the selling and buying divisions would have higher profits if they were to agree to the transfer. Nonetheless, if managers are pitted against each other rather than against their past performance or reasonable benchmarks, a non-cooperative atmosphere is almost guaranteed. Thus, negotiations often break down, even though it would be in both parties' best interest to agree to the transfer price. Given the disputes that often accompany the negotiation process, most companies rely on some other means to set transfer prices. So transfer at cost to the selling division. Many companies set transfer prices at either the variable cost or the full or absorption cost incurred by the selling division. The drawbacks of this approach include using full cost as the transfer price could lead to suboptimization because it does not distinguish between variable costs, which may be relevant to the transfer pricing decision, and fixed costs, which may be irrelevant. If cost is used as the transfer price, the selling division will never show a profit on their internal transfer. The only division that shows a profit is a division that makes the final sale to an outside party. Cost-based transfer prices do not provide incentive to control costs. If the actual costs of one division are passed to the next, there is little incentive for anyone to work on reducing costs. So there's that. Now, transfers at market price. A market price, or the price that is being charged for an item on the open market, is often regarded as the best approach to the transfer pricing problem. A market-based transfer price works best when the product or service is sold in its present form to outside customers and the selling division has no idle capacity. With no idle capacity, the real cost of the transfer from the company's perspective would be the opportunity cost of the lost revenue on the outside sale. And so this does not work well when the selling division has idle capacity. In this case, market-based transfer prices are likely to be higher than the variable cost per unit of the selling division. Consequently, the buying division may make pricing and other decisions based on incorrect market-based cost information rather than the true variable cost incurred by the company as a whole. And then we're going to look at learning objective 4, which deals with charge operating departments for services provided by service departments. So most large organizations have both operating departments and service departments. The central purpose of the organization are carried out in the operating departments. In contrast, service departments do not directly engage in operating activities. This appendix discusses why and how service department costs are allocated to operating departments. Okay. And then 4 reasons for allocating service department costs. So it encourages operating departments to wisely use service department resources to provide operating departments with more complete cost data for making decisions, to help measure the profitability of operating departments, and to create an incentive for service departments to operate effectively. And the service department charges compared in this appendix can be viewed as a transfer price that is charged for services provided by service departments to operating departments. And so charging costs by behavior. Whenever possible, variable and fixed service department costs should be charged separately to provide more useful data for planning and control of departmental operations. So a variable cost should be charged to consuming departments according to whatever activity causes the incurrence of the cost. A fixed cost should be allocated to consuming departments in predetermined lump sum amounts that are based on either the department's peak period or long-run average servicing needs. Importantly, fixed cost allocations are based on the amount of capacity each consuming department requires, and they should not vary from period to period. And so one thing to remember is that you want to think about why it would be better to charge managers a lump sum for access to service departments rather than including a markup for fixed cost in the charge for the department. The answer is that if the charge for the use of services exceeds variable costs and excess capacity exists, manager will demand too little of the service from the standpoint of the company as a whole. This discussion can be used to reinforce ideas developed when covering transfer pricing. Okay, budgeted variable and fixed service department costs rather than actual costs should be allocated to operating departments. Variable service department costs should be charged using a predetermined rate applied to the actual services consumed. A lump sum of fixed cost should be based on budget fixed costs, not actual fixed costs. And we're going to look at an example, SIPCO. So we're going to assume the following facts with respect to SIPCO. The allocation of maintenance costs to the 2 operating departments would be as follows. So SIPCO has a maintenance department and they have 2 operating departments, which is cutting and assembly. Variable maintenance costs are budgeted at 60 cents per machine hour, and the fixed maintenance costs are budgeted at $200,000 per year. And so we see as follows. So the variable costs would be allocated by multiplying the budgeted variable rate, which is 60 cents per machine hour, by the actual rate of activity level for each operating department. And so we see that how the number of hours planned, we would do that. So for 80 hours for the one department and then 40,000 hours for the other. For the cutting and the assembly department, we get the amounts there. Now, the fixed costs would be allocated by multiplying the percentage of peak period capacity for each operating department by the budgeted amount or the fixed amount, which is 200,000. So it'd be 120,000 and then 80,000. So quick quick check one. Foster City has an ambulance service that is used by two public hospitals in the city. Variable ambulance costs are budgeted at $4.20 per mile. Fixed ambulance costs are budgeted at $120,000 per year. Data reflects currently. So for each hospital, based on how much percent of the peak period capacity is required, and then the number of miles that are going to be planned for, and then the number of miles that are used. So the first thing we want to look at is how much ambulance service costs would be allocated to Mercy Hospital at the end of the year. So you're going to take find out the variable cost for Mercy, which is $4.20 a mile times 16,000 miles that they're using. So it's going to be 67,200. And then 45% of 120 of the fixed cost is going to be 54,000. So we add up both of those, we're going to come up to 121,200. Now, allocating the fixed costs using the variable allocation base that fluctuates period to period. And so rather than charge fixed costs by using departments and predetermined lump sum amounts, some companies allocate them using a variable allocation base that fluctuates. This is a pitfall because it creates a situation where the fixed costs allocated to one department are heavily influenced by what happens in other departments. Sales dollars is an example of a variable allocation base. It is a poor choice for an allocation base because sales dollars fluctuate from period to period, whereas the costs being allocated are often largely fixed. This creates a situation where the sales in one department will influence the service department costs allocated to other departments. And we're going to take a look at Autos R Us. And so again, we'll assume the following facts regarding Autos R Us. So Autos R Us has one service department and three sales departments. And so they sell new cars, used cars, and car parts. The service department costs total $80,000 for both years in this example. And contrary to good practice, Autos R Us is going to allocate their service department costs based on sales. So the allocations of the service department costs for 1 year are shown. The new cars department generated 50% of total sales and was allocated 40,000 of the service department costs. So we see that. So the sales, and then we're going to multiply by the percent of the total sales is what we're using to figure out the amount. Now, the allocation for year two are shown. Notice that the new sales, the new cars department increased sales by 500,000. So from 1.5 million to 2 million, while the other departments remained unchanged. The allocation of service department costs to the new car department increased by 5,714. So from 40,000 to 45,714, while it decreased the other two departments. The manager of new cars department is likely to complain that as a result of his efforts to expand sales, he is being forced to carry a larger share of the service department costs. And suppose that you are the division manager for a company that allocated fixed costs on a basis of actual sales. If the fixed costs allocated to your division were dependent upon sales in the other division, if they answered yes, ask if that's fair. There will probably be a chorus. Yeah, it's not fair, right? And if you think about this, this probably isn't, really, because if this is the amount of the service that's required, new cars probably don't require as much service as, let's say, the used cars, right? You get a car in maybe as a trade-in, or you get a car in as maybe you bought a car at auction and you're trying to ready it for sale. Your service department is going to need to spend a lot more in order to get that ready to be sold than, let's say, a new car that just comes in. So basing it on this, obviously it's not fair to base it on this. So there's better ways in order to base it on.